Welcome to The Explainer. Now, every business owner knows that payroll is, well, it's complicated. But what if I told you that there's a simple, really common mistake, a kind of hidden tax trap that could be silently erasing thousands from your bottom line? Today, we're going to uncover it.
Okay, so let's start with a really important question. You pay your employees bonuses, you handle their provident fund contributions, and you just assume, hey, it's a business expense, it's all tax deductible, right? But are you absolutely sure about that? That's the question we really need to dig into, because this is where a tiny, simple oversight can blow up into a huge, painful tax bill. During a tax audit, all eyes eventually turn to one very specific section of your report, Clause 20. And trust me, understanding this clause is the key to protecting your business.
So, let's decode this thing, Clause 20. The first thing you absolutely have to know is that it splits your employee payments into two completely different buckets. And getting this distinction right, well, it's everything. Okay, so here are the two buckets. On the left, you've got bonuses and commissions. That's money you pay to your employees. But on the right, you have PF or ESI. That's money you collect from them. This is so critical. Think about it like this. The bonus is your company's money. But that PF contribution, that's your employees' money that you're just holding in trust. And that fundamental difference is exactly why the tax rules are so incredibly strict and unforgiving for that second bucket.
All right, let's tackle bucket number one first, the bonus. The rule here is actually pretty simple and straightforward. Look, what the tax department is really trying to figure out here is simple. They want to make sure that bonus is genuinely for your employees' hard work and not just some sneaky way to hand out company profits and dodge dividend taxes. As long as you can clearly show it's tied to their performance, your deduction is usually safe.
And now, bucket number two. This is it. This is where the trap is sprung. Remember, we're talking about the contributions you collected from your employees' salary. How you handle their money is what this is all about.
So, what's the real deadline to get this money deposited? So many businesses just assume they have until their main income tax return is due. And that one single assumption, that is the costly mistake we are here to talk about. It can cost you a fortune.
The actual due date has nothing to do with the Income Tax Act. It's set by the specific welfare law itself, like the Provident Fund Act. And that means the deadline is much sooner, usually around the 15th of the next month. Why? Well, because it's not your money to hold on to. The government wants it deposited into your employee's retirement account right away.
This quote from the official guidance really just says it all. There's another part of the tax law, Section 43B, that sometimes gives businesses a little extra time, a little wiggle room to pay certain expenses and still claim them. But for your employees' PF contributions, this quote says that flexibility shall be deemed never to have applied. Let me translate that for you. There is no grace period. There is no wiggle room. The deadline is the deadline, period.
And here's the punchline. Here's the consequence. If you deposit your employee's contribution even one single day late, the entire deduction for that payment is disallowed. And I don't mean it's delayed. I mean it's lost forever. There are no extensions. There are no second chances. It's a permanent penalty for what might have been just a temporary delay.
So how do you avoid falling into this trap? Okay, that's the scary part. The good news is it all comes down to a really simple, practical, four-step compliance process. Here it is. This is your four-step defense. First, you've got to segregate. Your books, your accounting, it must scream that there's a difference between a company bonus and an employee's PF money. Second, know your dates. Don't just look at the income tax calendar. You have to find the specific, much earlier deadline for each welfare fund. Third, and this is huge, you have to verify the deposits. Don't just assume your team did it. Create a system, a check and balance, to confirm the money was sent before that deadline hit. And finally, keep the proof. Get those payment records, those challans, those bank statements, and keep them organized and ready. This isn't just about good bookkeeping. This is your evidence. This is what makes your business audit-proof.
So we end on this thought. Processing payroll, that's the easy part. But true tax compliance, that happens in the days after the salaries are paid. It's all in these little details. So the question you should be asking yourself isn't, did I pay my employees? It's, can I prove I handled my employees' money perfectly and on time? Because in the eyes of a tax auditor, there is a massive difference between those two questions.